Hello, I'm Todd Ganos, and thank you for joining me for this on-demand webinar regarding asset sales versus stock sales. Well, classically, there's been this tension between buyers and sellers regarding the tax characteristics of the deal. Sellers would like the preferential lower capital gain rate for the deal, whereas buyers, they're looking to reset the depreciation schedule on the underlying assets. As time has gone on, deals have tended to be asset sales. And when deals are asset sales, both the buyer and the seller complete a particular form that is attached to their income tax return for that particular tax year. And they both need to document not only the sale price, but also how the sale price was allocated among all the assets. And so you'll have receivables and inventory and property, plant, and equipment, and so on and so forth. And those two forms better agree. What the seller submits and what the buyer submits better agree, or there's trouble in River City. Okay, well, so the natural tendency is going to be, well, what if we just play with the numbers? You know, I get together, I'm the seller, I get together with the buyer, and we kind of, juice these numbers around. Yeah, they're going to get a reset on their depreciation, but if we juice these numbers a little bit, well, it's problematic, and this is where we have a story. Back a few years ago, there was a case that came out of the tax court where, I'll just say, one particular company tried to mess with the numbers, and the IRS, look, they just have their statistical methods that show that, that isn't the typical deal. And the tax court believed the IRS. And so really, if you're going to do an asset deal, you need to report what the real numbers are, okay? Don't try to monkey around. Don't get into trouble, okay? But the tension itself that typically most advisors talk about is really a false dilemma. There is actually a way for sellers to get the pure capital gain treatment that they're looking for. And it's also at the same time possible for buyers to get that reset on the depreciation schedule. Okay? It's how you structure the deal. And depending on the circumstances, your particular balance sheet, you might be able, as a seller, to reduce the total dollar amount of tax liability by 10 to 20%. So, of course, again, it all depends on your specific circumstances. So, what's that right structure for you? Well, why don't you drop me an email, send one to todd@integratedwealth.com. You can also read my Forbes column. The address is there. So as you approach your sale, we wish you the best of luck and the best of luck mitigating those taxes.